To keep yourself updated, subscribe to Indigo Learn and click the bell icon and download our app OneFin to start learning on the go.
So we have understood the disclaimer of opinion, okay, because there is no sufficient and appropriate evidence obtained by the auditor. So obviously we are going to end up giving a disclaimer of opinion because it is both material as well as the pervasive effect. Alright. So here you can see in the present case, CA Bahubali is unable to obtain sufficient appropriate audit evidence with respect to the following. That is, these two come from the question, that is, he is not able to find out the balance confirmation with respect to debtors, okay, because of which he is unable to decide the carrying value of the trade receivables as well. And also inventory, 38% of the company's inventory neither is physically verified nor there are adequate records maintained, because of which there is no evidence here as well. So in the above two circumstances, the auditor is unable to obtain sufficient appropriate evidence on which to base his opinion, and the possible effect on the financial statement of undetected misstatement, if any, could be both material and pervasive. So we study as per 705, if it is material and pervasive, we will end up giving disclaimer of opinion. Correct? So here thus CA Bahubali should give a disclaimer of opinion. So till here we were correct. Then let us understand how the format will look like. So what should be the content? Disclaimer of opinion is as good as no opinion absolutely given by the auditor, because he is not in a position to obtain evidence, and if there is no evidence, he cannot draw a conclusion. So basically, there is a position of not coming up with any of the opinion on the financial statement. Alright. So here, we do not express an opinion on the accompanying financial statement of Bharat Limited because of the significance of the matter described in the basis of disclaimer or opinion section of our report. We have not been able to obtain sufficient appropriate audit evidence to provide a basis for the audit opinion on these financial statement. So here you give the reference to the next paragraph, that is basis for disclaimer of opinion paragraph, where you are giving the reason why you could not find the sufficient appropriate evidences, and because of which you are ending up giving no opinion on the financial statements. Okay. Now, how does the basis for opinion paragraph look like? We are unable to obtain balance confirmation with the respect to debtors amounting to 240 crores. Further, there have been defaults on the payment obligation by the debtors on the due dates. The company has created provision for, see, all of this comes directly from the question. So you need to pick up the sentences correctly from the question. Strategically you have to write the answer. Okay. Then all of this comes from the question, and then you also write the carrying value of the trade receivables could not be ascertained. And the next reason is about the inventories. Again, all the things come from the questions, correct? And we are unable to undertake physical inventory count, and as such, the value of inventory also could not be verified. So these two will give you the reasons why you are giving a disclaimer of opinion. So that is the thing that you are going to write in the opinion paragraph, and then you have basis for opinion. That means why are we giving disclaimer of opinion, alright? Then the next question of this particular section was talking about how does a disclaimer of opinion paragraph look like? That means auditor's responsibility paragraph, when you give a disclaimer of opinion, what content does it have? Obviously, it is not going to be regular like when you give adverse opinion or when you give qualified or when it is an unmodified opinion. The way you give the auditor's responsibility paragraph and when you give a disclaimer of opinion is definitely not going to be the same. Alright. So let us see what it says. When the auditor disclaims an opinion on the financial statement due to an inability to obtain sufficient appropriate audit evidence, the auditor shall amend the description of the auditor's responsibility required in SA 700, forming an opinion on the reporting of financial statement to include only the following. So these three elements will come as a part of your auditor's responsibility paragraph. So first, a statement that the auditor's responsibility is to conduct an audit of the entity's financial statement in accordance with standards on auditing and to issue an report. A statement that, however, because of the matters described in the basis for disclaimer opinion section, the auditor was not able to obtain sufficient appropriate audit evidence to base his opinion on. The statement about auditor's independence and other ethical requirement. Correct? So here basically there are only three elements that we are going to capture, and these three only will pick up and write in the auditor's responsibility paragraph. Got it? Okay, I would recommend when you revise this, also revise what would be the auditor's responsibility paragraph with respect to other opinions. Okay, so this will give you a proper understanding of what is the difference happening between the two. Alright. So this is the question based on the audit report. Moving on to the next questions. Alright. So let us take up the next one. I think we have done with Yeah, now we are moving on with audit of CFS. Okay, this is consolidated financial statements. So let us look at the question and understand. Jambu and Sudharma Investment Limited is a company having a paid up capital of 1 crore. It has subsidiary, Investors Fund Management Limited. Major business of Jambu and Sudharma Investment Limited is to pool money from the investors on the collective basis and to invest the money in the various funds. The company pooled 12 crores from the number of clients which represent the company's shareholders. While auditing the books of accounts of Jambu and Sudharma Investment Limited, CA Vardhaman observed that whole amount of 12 crore pooled has been invested in the shares and the debentures of various companies, and the profit earned due to appreciation in the prices of these shares have been distributed to the various shareholders of the company. Performance of all its investments is measured at fair value basis. Now, CA Vardhaman raised an issue while auditing financial statements of Jambu and Sudharma Investment Limited, whether the consolidated financial statements are required as per section 129 subsection 3 of the Companies Act or not. Analyze the above issue and give your opinion. So, very simple question. Every element of the question is, the question is highlighting on one particular aspect, that is, we need to identify whether it is an investment entity or not. An investment entity is defined in Ind AS 110. Correct? So, you have to have good knowledge about the investment entity as described in Ind AS 110. Only then you will be able to give an answer to this question. First of all, you need to understand about consolidation, what section 129 subsection 3 tells. Whenever a particular company has a subsidiary, associate, okay, they are required to prepare along with their standalone financial statement another set of financial statement which we call it to be consolidated financial statement, which is going to be a consolidation of the parent company with all its components, that is the subsidiary, the associates and all of them. Alright. So, that is the basic requirement. But as per Ind AS 110, we know that if a particular entity is an investment entity as defined under this Ind AS, then that entity will be exempted from this requirement of consolidating the financial statement with its subsidiaries. Alright. So, you need to identify the character of the parent company, whether it is investment company or not. If it is, then you are exempted. That means even if you are not preparing a CFS, that will be allowed. Got it? So, here you need to identify first if it is CFS or not. For that, the criteria given as per Ind AS will be requiring about, first, the business should be to pool the funds. That is, they are also pooling the money from the investors. The reason is to invest the same in various funds, and whatever profit you earn due to appreciation of the profits or of the share prices are to be distributed to the various shareholders. Correct? And all of the performance of his investment is measured at the fair values. Correct? So, these are the criteria given as Ind AS 110. Correct? That means their first is to pool the monies together, then to invest this, then whatever appreciation is happening that you have to give it back in the form of return, and fourth one is based on the performance is measured on fair value. If all of these criteria are fulfilled, it becomes an investment entity. Therefore, here since everything has been fulfilled, this Jambu and Sudharma company becomes what? An investment entity as per Ind AS 1110, because of which it did not require to prepare the consolidated financial statements. So, here the question is telling you, now CA Vardhaman raised an issue while auditing the statement of Jambu and Sudharma Investment Limited, whether CFS are required as per section 129(3). Answer is not required, because they are investment entities as per Ind AS 110. They qualify with all the conditions given and hence they are exempted from the preparation. Clear? So, let us go and check the answer for this so that you get much more clarity in your understanding. So, moving on to the answer. According to section 129 subsection 3, so if you look at the answer given, here they talk about what is the meaning of consolidation. So, when are you required to consolidate? After that, they also talk about as per subsection 6 of section 129 of the Companies Act 2013, the central government may on its own on application made by class of companies by notification exempt any class of companies. Alright. Now, first you need to understand what is investment company. So, here as I told you, obtain funds from one or more investors for the purpose of investing or providing the management services. Commits to its investors that its business purpose is to invest the funds solely for returns from capital appreciation, investment income or both. Measures and evaluate the performance based on fair value. So all this is given in Ind AS 1110. An investment entity need not present CFS if it is required in accordance with paragraph 31 of Ind AS 110 to measure all its subsidiary at fair value through the profit or loss. A parent shall determine whether it is an investment entity. So the final answer will be applying the above given case of Jambu and Sudharma Investment Limited, which fulfills all the conditions stated above, it is an investment entity. By applying para 31 of 33 and 33 of Ind AS 110, it can be concluded that this is not it is not required to consolidate as per section 123 of the Companies Act 2013. Clear? So this is quite simple answer. Alright. Then moving on to the next question. Alright. So let us take the next one now. Now it's about audit of banks. Alright. Here. CA Prachi was conducting statutory audit of branch of a nationalized bank for the year 21-22. While reviewing operations and documents or papers of a borrower enjoying overdraft credit facility of 50 crore availed against security of stocks and book debts, following observations were jotted down by her. The balance in the overdraft credit facility as on 31st March 22 was 55.65 crores. The balance in the account exceeded sanction limit during the whole month. Okay. As per the terms of sanction letter, stock and book statements were required to be submitted monthly. Latest available stock and books debt statement for the month of February 22 showed drawing power of 48.50 crore only. However, stock or book debt statement of previous month showed adequate drawing power. Stock audit of the borrower was conducted during the year by one of the empaneled stock auditor of the bank. Stock audit report dated 31st December 21 placed on the record showed adequate drawing power in the account. However, it has been commented adversely on the declining turnover of the borrower in the year 21-22 to the date of the stock report as compared to the proportionate turnover in the preceding year. The renewal of the overdraft facility was due on 20th October 21. The account was short renewed by the competent authority for a period of 3 months pending submission of the complete papers. Alright. So they are talking about 4 things here. However, borrower has not submitted complete renewal papers till 31st March 2022. There is a request letter from the borrower on the record stating that the valuation report of the property located at a faraway location was taking time. The branch has classified the account as a standard asset. Considering the above, CA Prachi is in a dilemma relating to proper classification of the above. Advance guide her. Okay, this is all talking about whether the classification is correct or not. So basically, if you try to understand, it is the things which are given in here are giving you an indication that there has been a problem, but that is very much within the limits which have been allowed. Okay, so if you understand the clarity throughout the year, everything has been normal. Okay, there have been 1 or 2 problems here and there, because of which it is not going to turn into NPA. All right. So by RBI guidelines, where you have a problem in the completion of the papers and all of that, further extended timeline is given. Okay. Similarly, drawing powers also throughout the year they have been correct. For 1 or 2 months, if there are a problem, then you cannot turn it to NPA because we have a minimum period of 90 days to ascertain or convert a particular asset into NPAs. All right. So with that, let us see the answer the way they are given. See, first part of it will not do it again because it's all coming from the question. So we'll take from the point, comment on the declining of sales in the general informative value for the management making credit decisions. Now, the fact of overdrawing in the account during the month of March 22 and inadequate drawing power in the month are in the nature of temporary deficiencies and do not require an account to be classified as NPA in accordance with the asset classification and provisioning norms of RBI. Because there has to be a discrepancy, there has to be a problem of at least 90 days minimum for it to turn into NPA. So it is in February and one is in March. So it's going to be only 30 days and 30 days. So that is not crossing the period of 90. Alright. Then RBI instructions lay down that ordinarily credit limits need to be reviewed not later than 3 months from the due date. Agreed. As per the guidance note on audit of bank, in the case of constraint such as non-availability of financial statements and other data from the borrower, the branch should furnish evidence to show that review of the credit limits is underway and would be completed soon. So you have to give it in record, okay, that things are happening, but they're taking some time. Okay, there has to be an evidence given. In any case, delay beyond 6 months is considered as not considered as good thing. Okay, so delay beyond 6 months is not considered desirable as a general discipline. Hence, an account where the credit limit have been reviewed or renewed within 180 days from the due date will be treated as NPA. So here in the question, it was only 3 months timeline, but you'll be allowed how much time? 180 days. Alright. So that will not turn into NPA again. It would be pertinent to note that the counting of 180 days would be required to be done from the date of original date of the renewal and not from the date of expiry of short reviews and technical reviews. In the instant case, the original date of renewal was 20th October. So 20th October, 180 days, 6 months. So October, November, December, Jan, Feb, March. So in the month of March, 31st March, 180 days are not completing, because of which this is not going to turn into NPA. Alright, then. Keeping in view all the above factors, CA Prachi should accept classification of the account as standard asset made by the branch. Alright. So here the points to be taken into consideration is regarding stock audit report was given, that's fine. Then they had adequate drawing throughout the year. Whatever information is given regarding the declining sale is only informative in nature. Then whatever deficiencies occurred in the month of March or drawing power declining in the February, they are all temporary deficiencies which cannot categorize it as NPA. Further, whenever there is renewal and review, this 3 months period is acceptable, agreed. But then if there is a delay, okay, in your documentation work to be completed, you have to give an evidence that yes, it is in process. But maximum timeline available will be 6 months. But this 6 months is not from the expiry, okay. It will not be from the expiry of the short review. It will be from the date on which it was reviewed or renewed. So that is going to be here in our example, 20th of October you are going to calculate. Alright. So basically taking into account everything, there is nothing in the question which is telling the account has to be treated as NPA. So it is very much correctly classified as standard asset. Clear? Alright. Moving on to the next question, that is question number 20. Sudarshan Limited is a company registered under the Companies Act 2013. The company is engaged in the business of loans and advances, acquisition of shares, stocks, bonds, debentures, securities issued by government or local authorities. For the year ended 31st March 2022, following are some extracts from the financial statements. Paid up capital, non-current assets, loans and advances, current assets, total asset of the company, intangible assets, profit for the year, income from interest and dividends, gross income. Directors intend to apply for registration of NBFC under section 45IA of the Reserve Bank of India Amendment Act 1997. Advice. Okay. So here, obviously we are going to talk about the 50-50 thing. Alright. And we are going to apply the formula and then check about the financial and the non-financial asset discussion. And if it is fulfilling the criteria, then you have to get it registered, otherwise not. So let us look at the calculation. So by the understanding, we know that by the RBI rules, any company will be considered to be an NBFC if two conditions will be satisfied. So basically we call it to be the 50-50 rule. So the first condition will be regarding the financial assets should constitute more than 50% of the non-financial assets. Second, the income from the financial assets should be more than 50% of the gross total income. But when we take, gross income. But when you talk about total assets, you have to be very careful that you net off the intangible assets. That's very, very important. If these two criteria will be fulfilled, then in that case, it will be considered to be an NBFC. And if it is NBFC, the registration becomes mandatory by RBI. Alright, then. So here in the question, loans and advances are the non-current assets and non-current and current assets, which are the financial assets. So here you see non-current assets, loans and advances are taken. On that we are adding the current assets, loans and advances. So the total of the two comes to 369.83 crores. Total assets if you take into account is 618.55. But from there we need to minus the intangibles. So total is 612.20. Alright. Now, if you look at the comparison, it is definitely more than 50%. Alright. So financial assets are more than 50% of the total assets. Then, second criteria talks about financial income, the income from the financial assets. Alright. So income from the financial asset as given in the question 62.31. Gross income is going to be 111.23. This also is crossing the criteria. So the income from the financial assets constitute more than 50% of the gross income. Hence, Sudarshan Limited fulfills both the criteria to qualify as NBFC, because of which it has to get registered under section 45IA of the Reserve Bank of India Amendment Act 1997. Clear? So this was purely based on calculation. If you remember these two conditions, the entire question is simple. Alright? If there is not even complications in finding out which is financial asset or intangible assets, very clearly they have given. So there are not going to be any confusion here in calculation. Only thing you should remember the criteria very well. Okay, then moving on to the next question, 21st, Bilimoria and Bilimoria, a partnership firm, is engaged in providing engineering consultancy services to the insurance corporates in automobile sector. The firm conduct risk inspection of the vehicles and submit their reports to the insurance companies. So they provide to insurance corporates in an automobile industry, okay, sector, okay. Both the partners are chartered engineers. The firm is one of your regular tax audit client. The following information is culled out from the account books of the company for the financial year 21-22 by the firm. Pulled out. So turnover, receipt on accounts of sales, debtors, cash receipts, expenditure during the year, cash expenditure, cash loan repayment. The partner of the said firm informs you that due to changes in income tax law, their firm is not liable for the audit under section 44AB of the Income Tax Act, commonly called as tax audit. How do you deal with the matter? Is contention of the partner in accordance with law. So basically they are testing you the knowledge of section 44AB. Do you know the threshold limits? If you know, you'll be able to get the answer very easily. So when you do a clear scrutiny of section 44AB, then we clearly understand that the threshold limit given is regarding 1 crore. But in case of business, there has been some more additional part where the threshold limit has been extended to 10 crore, required some conditions were given, correct? But if you read the section very clearly, it is for business, correct? But here the question is based on profession, okay? So you need to clearly understand where they are highlighting it, okay? So here they are into consultancy services, so they are professionals, where if their receipts cross 50 lakhs, compulsory they have to get their accounts audited, correct? The tax audit has to be conducted. So here the question, sometimes they give it in such a manner, all the additional information will be given in such a manner that you try to put in the threshold limits which are extended, the 10 crore one. In that case, we'll start thinking in that direction. So we need to come out of this manipulative aspect and understand the main aspect is consultancy services. So it is a profession. So there the limit is going to be what? 50 lakhs, correct? So let us understand properly. Section 44AB, clause A of the Income Tax Act 1961 prescribes that a person carrying on business shall get his accounts audited if his total sales, turnover or gross receipt exceed 1 crore in the previous year, in any previous year. However, this limit was enhanced to 10 crore in the following cases. Aggregate of all the amounts received, including amount received from sales, turnover or gross receipt during the previous year, in case does not exceed 5% of the said amount. In cash, does not exceed 5% of the said amount. And aggregate of all the payments made, including amount incurred for expenditure in cash during the previous year, does not exceed 5% of the said payment. Alright. However, section 44AB, clause B of the Income Tax Act states that in case of profession, every person shall get his accounts audited if the gross receipt of the profession exceeds 50 lakhs. Correct? The above said firm is engaged in providing engineering consultancy service to the insurance corporates. Hence, the benefit is enhanced to the threshold limit is not available to the person engaged in professional activities. So, the key to the answer is here. Alright, then. The information regarding cash receipt and payment, although falling within 5% of the total receipts or payment, is not relevant in the given case because it is not business, it is purely profession, where the criteria will not be applicable only. Alright. So very intelligently they give you all the additional information so that you actually make use of it and start thinking in that direction about 10 crore threshold, correct? But here you need to concentrate the kind of business the assessee is carrying on. So it is not the business, it is the profession, the nature of the whether it's profession or business. Clear? Alright. So that's quite simple. So the contention of the auditor, the partner is not correct. It has to get the accounts audited. Alright. Then moving on to the next question. It's about audit of public sector undertakings, 22. The CAG appointed Sambhav and Associates, a chartered accountant firm, to conduct performance audit of MAP Limited, a public sector undertaking of the Government of India. The firm conducted the audit with a view to check all the expenses of the unit are in conformity with public interest and publicly accepted customs. The audit report submitted by the firm was rejected by CAG. Give your opinion on the action of CAG. Understand, here it is performance audit, but if you look at public interest and publicly accepted customs, you're talking about proprietary audit. So basic sense is the report submitted will definitely get rejected by CAG, correct? So that is basically here the things have not got in line. So here basically it is what they have done is a proprietary audit, and what has been questioned is the performance audit. And in the performance audit we look into economy, effectiveness and efficiency, okay, of the audit of the government programs, activities, all of that conducted. So basically the audit should be planned and strategized in such a manner that you are looking into the economical and effectiveness and the efficiency of the programs, correct? But here they are looking into the public interest and the publicly accepted customs, which definitely what CAG has done by rejection is very much in line, okay, because they are not done what is required to be done as per the given regulation, correct? So here the 3 E's basically talk about the performance audit. This is what had to be checked regarding the programs and the activities of the government, but they have looked into the proprietary, which is absolutely not correct. So here the CAG's rejection is absolutely in line, okay. I would recommend you go through the answer in the suggested one so that you get a clear understanding of how you write it, okay. Then peer review and quality review. 23rd question A. What are the important areas for evaluation while conducting quality review in terms of SQC? Now this also again straight question, you can just refer SQC1 and you would get an answer for this, okay. It's quite simple, so we'll not spend much time in discussing because it's quite clear. So you could read the suggested answers and you'll get the answer for this, alright. Then B. Prabhu and Company LLP is a large firm of chartered accountants based out of Mumbai. Prabhu and Company LLP is subject to peer review, which was last conducted 3 years back. For the peer review of the financial year ended 31st March 21, the firm got an intimation on 29th May 21. The process of peer review got started and was completed on 27 September 21. In the view of peer reviewer, the system and the procedure of Prabhu and Company LLP are deficient and non-compliant. The system and procedures of Prabhu and Company LLP are deficient and non-compliant. The peer reviewer did not share any of his observation with Prabhu and Company LLP as a draft, and the final report was submitted to the board. Comment. Okay. So proper reading is Prabhu and Company is a large firm of chartered accountants. They were subject to peer review 3 years back. In the financial year ended 31 March 21, the firm got an intimation on 29th May 21. Alright. So for doing the peer review of 2021, they have got it on 29th May 21. The process of peer review got started and was completed on 27th September 21. Okay. In the view of peer reviewer, the system and the procedures of Prabhu and Company LLP are deficient and non-compliant. The peer reviewer did not share any of the observation. Alright. So here whatever deficiencies have been identified, okay, it is under the peer review of the practice unit. Then in that case we know very well that this has to be first intimated to the practice unit before you give it to the board. So always the peer reviewers, whenever they identify any deficiency, anything which is non-compliant, they first have to inform whom? It has to be informed to the practice unit. And then the practice unit will be given a timeline to respond back to it. And after receiving the response, only then the report will be given to whom? To give to the board. On the contrary, if suppose the reply of the practice unit has not been reasonable or not satisfactory, then a modified report can be issued which will be given to the board. If a modified report is issued, then what will the board do? They will ask for a follow-on report or follow-on review will be conducted. But that should be finished within 1 year. Okay, within a period of 1 year, a follow-on review has to be conducted. Sometimes the timeline will be even reduced to 6 months. Correct? It could be lesser, but the least will be how much? 6 months. Alright? So all of this is what you have to write here. So if you have a quick understanding, after completing the on-site review, the peer reviewer before making his report to the board shall communicate his findings in the preliminary report to the practice unit. So the report that you send to the practice unit, we call it to be preliminary report. If in his opinion systems and the procedures are deficient or non-compliant with reference to any matter noticed by him, to seek clarification. Practice unit will reply within 15 days, okay, and make submissions or representations in writing to the reviewer. At the end of the on-site review, the reviewer is satisfied with the reply, then he will send it to whom? The copy of the report shall also be forwarded to the board. And also will be forwarded to the practice unit. In case the reviewer is of the opinion that response of the practice unit is not satisfactory, the reviewer accordingly submit modified report to the board incorporating the reason for the same. The copy of the same shall also be forwarded to the practice unit. In case of modified report, the board shall order follow on review after a period of 1 year from the date of issue of the report. If the board so decide, the period of 1 year may be reduced, but should be 6 months from the date of issue of a report. So in this case, whatever the Prabhu and Company LLP, okay, is telling is correct, because the peer reviewers have directly submitted the report to the board, which is incorrect because it had some deficiencies, some modifications. So before informing the practice unit being Prabhu and Company LLP, if they have directly informed the board, it is not in line with the proper format which is given. Alright. So that is not acceptable, and Prabhu and Company LLP, what their contention is absolutely valid. Alright. Now moving on to the last part, that is talking about the professional ethics. Okay, so the questions in the RTP about professional ethics are very simple. Okay, so we'll have a quick glance of it so that you understand. Comment on the following with reference to the Chartered Accountants Act 1949 and the schedules thereto. CA Dev started practice in Punjab in the year 2019. CA Dev issued turnover certificate for Messrs ASA US traders to be forwarded to the bank for the purpose of availing cash credit facility and machinery term loan. Brother of CA Dev was a proprietor of Messrs ASA US traders. Now this is absolutely not allowed, because if it's a relative, okay, as defined, then in that case, if you are issuing such reports which are to be submitted to the banks for the purpose of availing the credit facility, it cannot be done. Okay, so definitely here CA Dev is guilty of professional misconduct. So it is the clause 4, okay, part 1, second schedule. Okay, we are not allowed to take these kind of assignments of your relative, and here the relative will be as per AS 18. Correct, and brother is very much covered there, and because of which here CA Dev is guilty of professional misconduct. Then next one, Agam Private Limited requested CA Sheetal, a practicing chartered accountant, to digitally sign the form related to resignation of Mr. Rohit, one of the director of Agam Private Limited, along with the copy of resignation letter to be uploaded on the website of the Registrar of Companies. The signature of Mr. Rohit was simply copied and posted by another director of Agam Private Limited. CA Sheetal, without verifying the genuineness of the resignation letter, digitally signed the form, and the said form was uploaded on the website of the Registrar of the Companies. So what CA Sheetal has done, she is guilty of gross negligence. So whenever you perform the audit, it is your responsibility to do your duty with thorough due diligence, and you should not be doing something with negligence. Okay, so this is covered by clause 7, first part 1, just 1 second. It is clause 7, part 1, second schedule. Correct? Where you will be guilty of your professional misconduct because of not carrying on your duty with, with due diligence, or you are grossly negligent while performing your duty. So here it was very important to verify the genuineness and only then give a signature. So as per this particular clause 7, part 1, second schedule, CA Sheetal is guilty of professional misconduct. Alright, then. Last part, write a short note on the following. So this, I think you can have a look at it, because these are the 3 things given. So you could have a reference to the suggested answers and you'll get an answer for this. So management audit questionnaire, pre-look cancellation, and service rendered by forensic auditors. So this, you could look at the suggested answer and get an understanding for it. They are all the short notes that they are asking you to write it. Alright. So I think with this, we'll be done with the total RTP. Okay, and I believe with this you'll be able to understand the kind of questioning which the institute is now doing. Very rarely you will see a direct question or a very theoretical question, except for certain topics particularly. Otherwise, everywhere else there is applicability happening. Alright. So very importantly, whenever you study any topic, it has to be in-depth preparation, because without that, attempting a paper like these will become very difficult. When you read, the reading has to be very clear, because sometimes the students do mistake while reading the conditions like the criterias and all, where the words will be and, that is cumulative, and students happen to read it or. So that point of time, because of your reading which is being very summarized, in the exam you'll have a confusion whether it should be and or. Alright, like when you saw the NBFC provision here, so the criteria is both to be fulfilled. So when you don't read it correctly, in the exam point you'll be having a problem whether it was and or it was or. So the reading has to be properly in line. Okay, second, we saw that questions have been tested purely based on concept, and only if your concepts are clear, application will be there. Okay. So I believe with this, the entire RTP will definitely make sense to you, and you will be in a position to understand what should be the framework of your mind when you're preparing, and also with the suggested answers, you will understand the way in which you're supposed to write the answers. Alright. So with this, we close the RTP for the November 22 examination, and for all those who are hearing this, I really wish that you all perform very well, okay, and all the very best to all of you.